The market didn't just move, it left a trail of evidence that most people are ignoring. While the dollar index sits calm on your screen, something violent is happening beneath the surface. Central banks aren't just diversifying their reserves. They're physically withdrawing metal from Western vaults at a pace we haven't seen since the early 70s. The headlines chase Fed meetings and rate cuts, but the real capital is moving in silence. By the end of this briefing, you'll understand the mechanical dismantling of the dollar settlement system. Not the collapse, the hollowing. The structure still stands, but the load-bearing assets are being removed from the foundation. There's a specific moment when this became irreversible. I'll show you exactly when. Let's start with the part they bury under the noise. Central banks bought over 1,000 tons of gold annually for 3 consecutive years. 2022, 2023, 2024. That's nearly double the 400 to 500 ton average from the previous decade. This isn't a blip. This is a structural shift in how sovereign nations are managing their reserves. But the raw tonnage isn't even the most revealing part. Look at where that metal is going. In 2020, roughly 50% of central banks stored their gold onshore in their own vaults. By 2024, that number jumped to 68%. An 18-point shift in 4 years. That's not gradual diversification. That's coordinated repatriation. India moved approximately 100 tons from the Bank of England back to domestic vaults in 2024. Poland added 90 tons and publicly stated their goal to increase gold to 30% of national reserves. Germany, Hungary, Turkey, the Netherlands. All of them pulled metal home over the past decade. China has been even more aggressive. Reported reserves reached 2,280 tons by the end of 2024. They purchased gold for 10 consecutive months through 2025. And here's the part that matters. China doesn't just buy, they store it domestically. They don't trust Western custodians. Now, some analysts will tell you, this is just standard reserve diversification. Central banks want a mix of assets. Gold, dollars, euros, yen. Nothing to see here. That explanation falls apart when you look at the survey data. 95% of central bankers expect global official gold reserves to increase over the next 12 months. 76% believe gold will comprise a higher share of their reserves 5 years from now. And here's the number that tells you everything. 0 surveyed central banks plan to reduce their own gold holdings in the near term. 0. When the entire institutional class agrees on direction, you're not watching diversification, you're watching an exit. But the tonnage and the survey data are still just surface-level evidence. The real tell is in the custody structure, because when you move metal from London or New York back to your own vault, you're not just changing the address on a spreadsheet. You're removing that gold from the rehypothecation chain. Let that land for a second. The Western bullion banking system doesn't just store gold. It uses that gold as collateral. The same physical bar backs multiple paper claims, sometimes 10 to 1. When a sovereign buyer demands physical delivery and moves that metal to a domestic vault, they're pulling the collateral out from under hundreds of derivative contracts. The Bank of England still holds 400,000 bars of gold, mostly foreign reserves. It's still the top custodian globally, but the exit door is narrowing. Each ton that leaves London reduces the liquidity base for the entire paper market. And here's where it gets interesting. Central banks aren't just moving gold. They're moving it during a period of flat global mine production. Annual mine output is roughly 3,000 tons. Central banks are absorbing 1/4 of that every single year. The math doesn't have an agenda. If demand stays at 1,000 tons annually and production stays flat, where does the next decade's supply come from? Either prices rise to ration demand, or the paper market starts to crack under the weight of delivery requests it can't fulfill. This is the fingerprint, not just the buying, the physical migration, the repatriation, the removal of metal from the Western custody system at a pace that the system was never designed to handle. Now that you understand the scale, let's look at the plumbing they don't want you to see. Most people think gold trading happens in vaults, bars moving from one secure room to another. That's not how the system works. The vast majority of gold traded globally never moves at all. It's paper, contracts, digital entries in a ledger. This is the structure of the London Bullion Market Association and COMEX, the 2 largest gold markets in the world, and they operate on a principle called rehypothecation. Here's how it works. A bank holds 1 physical bar in a vault. Let's say it's a 400-ounce London Good Delivery bar. That bar becomes collateral. The bank can lend against it, sell unallocated claims on it, use it to back futures contracts. The same bar can support 10 different paper claims, sometimes more. This isn't a conspiracy. It's disclosed. It's legal. It's how the system maintains liquidity. The problem is that it only works if most people never ask for physical delivery. Think of it like a theater. 1,000 tickets sold for a room with 100 seats. As long as only 10% of ticket holders show up, nobody notices. But the moment everyone tries to walk through the door at the same time, the structure collapses. In the gold market, central banks are the ones heading for the exits. When India moved 100 tons from the Bank of England, that wasn't just a transfer. It was the removal of collateral backing potentially 1,000 tons of paper claims. When Poland added 90 tons and stored it domestically, they pulled the foundation out from under derivative contracts that traders in London were using to hedge positions. The LBMA and COMEX function as pricing mechanisms. They set the global benchmark, but they're not designed for mass physical settlement. They're designed for paper trading with occasional delivery. Now add the regulatory gap. In the United States, Federal Reserve Regulation T limits rehypothecation to 140% of a client's net liability. That sounds like a lot, but it's actually a ceiling. In many other markets, there are no limits at all. A bank in London can rehypothecate the same bar as many times as credit markets will allow. This worked fine for decades. But it worked because Western central banks weren't demanding delivery. They were content to hold unallocated claims, contractual rights to equivalent metal, not specific bars. That trust is gone. Let's talk about what unallocated actually means. When you hold unallocated gold, you don't own a specific bar. You own a claim on the bank's promise to deliver equivalent metal at some future date. You're an unsecured creditor. If the bank fails, you get in line with everyone else. History shows us what happens when that line forms. During the 2008 financial crisis, Lehman Brothers used client gold as collateral to obtain funding. When Lehman collapsed, secured creditors, the big banks, claimed those assets. The clients with unallocated gold? They became unsecured creditors. They got nothing. The Federal Reserve even issued a warning about this. Quote, "An investor is always vulnerable to a securities intermediary that does not itself have interests in a financial asset sufficient to cover all of the securities entitlements that it has created in that financial asset." End quote. That's regulatory language for, if the bank doesn't actually have the metal, you're exposed. Central banks learned this lesson, not from Lehman, from something much more recent. The structure I just described, the rehypothecation chain, the unallocated claims, the paper-to-physical ratio, all of it depends on one assumption, that sovereign reserves held in Western financial centers are safe, untouchable, neutral. That assumption broke in February 2022. And when it broke, it didn't just crack the trust between central banks and Western custodians. It revealed that the entire settlement system could be weaponized overnight. This is where the forensic evidence gets uncomfortable, because the moment I'm about to show you wasn't a market event. It was a political decision that had mechanical consequences nobody wanted to admit. Let's separate signal from noise. Here's the question nobody wants to say out loud. In February 2022, the G7 froze approximately 260 billion euros of Russian central bank reserves. The stated reason was sanctions following the invasion of Ukraine. The immediate narrative from Western financial media was that this would have minimal impact on dollar confidence. After all, only 20 billion of those frozen reserves were held in dollars, a negligible fraction of the 7 trillion in global dollar reserves. That explanation is technically correct and completely misleading. The dollar amount wasn't the signal. The precedent was the signal. For the first time in modern history, sovereign assets held in Western financial centers were weaponized overnight, not through a market mechanism, through a political decision. And every central bank on the planet watched it happen in real time. Now here's the part that reveals Russia saw this coming. In the summer of 2019, Russia deliberately moved almost all of its dollar holdings out of U.S. custodians. They cut their dollar share to just 15% of reported reserves. This wasn't a reaction to the freeze. This was preparation 3 years in advance. Russia knew that reserves held in Western custody could be seized. They acted on that knowledge. And when the freeze actually happened, It confirmed what every non-Western central bank had quietly feared but never said out loud. Your reserves aren't really yours if someone else holds the keys. The immediate response was predictable. China accelerated gold purchases. India began repatriating metal from London. Poland publicly announced plans to increase gold to 30% of reserves. Turkey moved aggressively into physical accumulation. All of this happened within 18 months of the freeze. But the deeper damage wasn't just to dollar confidence. It was to the entire concept of holding reserves in Western financial institutions. Think about the mechanics. When you hold U.S. Treasuries, you're holding debt, a promise to pay. When you hold gold in a vault in New York or London, you're holding a physical asset, but you're trusting the legal and political framework of that jurisdiction to let you access it. The freeze proved that trust was conditional. Now, some analysts argued that Russia was a special case, an aggressor state facing sanctions. This wouldn't happen to other countries. The system was still safe for everyone else. That argument collapsed in December 2025. The European Union voted to freeze Russian assets indefinitely. Not for 6 months. Not pending negotiations. Indefinitely. And then the conversation shifted to something even more destabilizing. Confiscation. The proposal to seize frozen Russian assets and use them to fund Ukraine's reconstruction introduced a new level of risk. Because freezing is reversible, confiscation is permanent. And if Western governments can permanently seize sovereign reserves held in their custody, then every central bank has to ask a very simple question. What stops them from doing this to us? President Putin warned that seizing assets would undermine confidence in the Eurozone. For once, he wasn't wrong. The Russian central bank filed a $230 billion lawsuit against Euroclear. Legal experts debated whether sovereign immunity applied. The whole structure became a geopolitical chess match, but the central banks didn't wait for the legal debate to resolve. They acted on the precedent, because here's what the freeze revealed. Reserves held in Western financial centers aren't just vulnerable to market risk. They're vulnerable to political risk, and political risk can't be hedged with derivatives or diversification strategies. The only hedge is physical control. This is why the repatriation trend accelerated so dramatically after 2022. It wasn't about returns. It wasn't about portfolio optimization. It was about sovereignty. When you move gold from the Bank of England to a vault in New Delhi, you're not just changing the address. You're removing that metal from a jurisdiction that just demonstrated it will freeze assets when geopolitical interests align. The freeze of Russian reserves wasn't just a sanctions move. It was the moment the plumbing broke. And now that central banks understand the system can be weaponized, they're installing independent power grids. Let's separate signal from noise. When central banks hold U.S. treasuries, they're holding debt instruments, promises to pay. When they hold gold in their own vaults, they're holding final settlement. No counterparty risk, no political conditions, no legal jurisdiction that can override access. This distinction matters more than most people realize. A treasury bond is a claim on future U.S. tax revenue. It's backed by the full faith and credit of the United States government. That sounds solid until you remember that faith and credit are subjective. They depend on fiscal policy, monetary policy, political stability, the willingness of Congress to raise the debt ceiling, the Federal Reserve's commitment to maintaining dollar purchasing power. Gold doesn't have those dependencies. Gold is. It exists. It weighs what it weighs. It doesn't require a functioning government or a solvent central bank or a cooperative legal system. This is why the shift from treasuries to gold isn't just portfolio rebalancing. It's a structural change in how central banks define risk. When you trust the U.S. fiscal system, you hold treasuries. When you trust physics, you hold gold. The survey data makes this explicit. 95% of central bankers expect global gold reserves to increase. 76% believe gold will comprise a higher share of their reserves in 5 years. Zero plan to reduce holdings. But here's the revealing part. When asked why they're increasing gold allocations, the most common answer isn't returns. It isn't inflation hedging. It's geopolitical risk and asset security. They're not buying gold because they think it's going up. They're buying gold because they no longer trust the system that holds their other reserves. Now, add the mathematical reality. The dollar's share of global central bank reserves has been declining for 2 decades. It peaked above 70% in the early 2000s. Today, it's closer to 59%. That's an 11-point drop. Where did that capital go? Some went to euros, some to yen, some to yuan. But an increasing share went to gold. And gold has a unique property that no fiat currency has. It can't be printed. Every other reserve asset is someone else's liability. Treasuries are U.S. government debt. Euros are European Central Bank liabilities. Yen are Bank of Japan liabilities. When you hold those assets, you're trusting the issuing institution to maintain value. Gold is the only reserve asset that isn't someone else's promise. When you own it, you own it. There's no counterparty, no issuer, no central bank that can debase it by expanding the monetary base. This is what final settlement means. The transaction is complete. There's no future claim to resolve, no derivative contract to unwind, no rehypothecation chain to trace. Central banks are swapping paper promises for physical weight, and they're doing it at a pace that's structurally significant. 1,000 tons annually equals 1/4 of global mine output. If that continues for another decade, central banks will have absorbed 10,000 tons from a market that produces roughly 3,000 tons per year. The math doesn't work unless prices rise to ration demand or the paper market breaks under delivery pressure. But even if prices rise, that doesn't solve the trust problem. Because the issue isn't whether gold is expensive. The issue is whether reserves held in Western custody are safe. The freeze of Russian assets answered that question. And the answer was no. Not if geopolitical interests shift, not if sanctions become a tool of foreign policy, not if sovereign immunity can be overridden by political consensus. Central banks heard that answer, and they responded by installing independent settlement infrastructure. This brings us to the part that makes the whole structure fragile. Now, add the next layer. The theater analogy I used earlier isn't just a metaphor. It's the actual mechanical structure of the London and New York gold markets. 1,000 tickets sold for a room with 100 seats. The system works fine as long as most ticket holders don't show up. But central banks are showing up, and they're not asking for a seat. They're asking for the specific bar with their serial number on it. Then they're walking out the door with it. The Bank of England still holds 400,000 bars. It's still the world's top custodian. But look at the trend. Sovereign clients are quietly moving metal home. India took 100 tons. Poland took 90. Germany repatriated significant portions over the past decade. Hungary, Turkey, the Netherlands. All of them reduced their London exposure. Each ton that leaves reduces the collateral base for the entire paper market. Here's why that matters mechanically. When deliverable bars in the right formats become scarce, rehypothecation capacity physically shrinks. A bullion bank can't lend out a bar that's sitting in a vault in New Delhi. They can't use it as collateral for 10 different derivative contracts. The metal is gone. It's outside the system. And when the collateral base shrinks, liquidity tightens, spreads widen, delivery requests become harder to fulfill, the paper-to-physical ratio compresses. This is the cascading effect. Each repatriation event removes more than just that specific tonnage. It removes the multiplier effect that made the paper market function. The system isn't collapsing, not yet, but it's being hollowed. The structure still stands. The LBMA still sets the benchmark. COMEX still trades futures. The dollar index still looks calm on your screen, but the foundation is being removed. Ton by ton, vault by vault, jurisdiction by jurisdiction. The verdict is simple. The dollar isn't collapsing. It's being structurally de-weighted as the foundation of final settlement. Central banks aren't abandoning the dollar for transactions. They're abandoning the dollar for trust. And this is why the freeze of Russian assets wasn't just a sanctions move. It was the moment the plumbing broke. Because it proved that reserves held in Western custody could be weaponized. And once that precedent was set, every central bank had to ask the same question. Do we trust the system enough to leave our metal in someone else's vault? The answer is in the data. 68% onshore storage. 1,000 tons of annual purchases. 0 central banks planning to reduce holdings. They've already answered. Central banks are installing independent power grids because they no longer trust the Western settlement system. The metal is moving. The plumbing is breaking. Follow the metal, not the headlines. Subscribe to track the evidence.